Hey people, are you the kind of person who wants 50% return straight away from your investment and get nothing, no return for the next 4 years? Or you are someone who wants 10% return every year consistently for the next 5 years? Now, I tell you what, if you are pondering which kind of investment return you should be chasing, stay tuned for this video after the break. Alright guys, now there are two types of investment return. One is the fast, one is the boring. So depending on your view, you might want to chase high return in 1 year and just be done with it, like Bitcoin perhaps. So there's one type of investment return that is the boring type, the boring consistent performer that gives you 8-10% return per year, versus the one that can give you 50% straight away in year 1 or in the 3rd year, but then get nothing again for the next 4 or 5 years, which is called the 0 to hero and then back to zero type of investment. Now, let's give an example. If you have a portfolio A, which gives you 50% in the 3rd year, but you have to contend with having 0% return or even negative return in the 1st year, 2nd year, 4th year, and 5th year. Now, just to standardize the two scenarios that I'm comparing here for you, let's just say that you want a 50% return for the next 5 years. Now, you want it to have 50% kind of return in one single year and get nothing for the rest of the 4 years before and after this, like what I've shown you here, or you want something, a portfolio B that gives you 10% every year for the next 5 years. Now, I know that for you who are a little bit financially savvy, you might say, hey, 50% return. This is the layman calculation, but exactly it's actually lower than that. I know, but this video is for the people who do not have that kind of financial knowledge about compounding. Of course, there's a way to calculate it, which I've calculated this for you. Now, if you want a 50% gain out of your investment for the next 5 years, actually, if you calculate it from a financial standpoint, it's about 8% compounded return every single year. At the end of 5th year, you will get a 50% total return out of your investment capital. But this is just a layman calculation, because if you say 50% for 5 years, then naturally a layman calculation will divide that by 5, which is equal to 10% per year. So back to my question is, do you want this kind of return or do you want this kind of return? Now, it's nothing right or wrong, but if I were to manage a portfolio for you, I would rather give you something of this one or this one rather than this one, because this one, there's really no guarantee. There's no guarantee that you can be a hero in 1st year 50% return, but there's no guarantee you will be able to repeat that for the following years. In fact, it's unlikely that you will be able to repeat that. And if you don't believe me, then you should Google and search for what we call as a modern portfolio theory, okay, the MPT. Now, MPT is, if you want to argue, it's by a Nobel Prize winner in economics. His name is Harry Markowitz. If you are already a financial advisor, you're in wealth management, you should already know this. This is a curve between the expected return and the risk or the volatility. Because again, in layman terms, it's about risk and reward. You absolutely could not, according to a Nobel Prize winner, and this is true, right? This is true not only in theory, this is true in practice. You absolutely not able to get a higher return, but at a same level or a reduced level of risk, unless of course you are investing in things like which is non-market correlated, like private equity, okay, or in business. But when you're talking about the stock market, equity market, or even bond market in general, everything follow this what we call as a modern portfolio theory. In other words, to quote the modern portfolio theory in its exact definition, it says that no added diversification can lower the portfolio risk for a given set of return. Now, if you are investing in any kind of portfolio, a diversified portfolio, you want, according to this curve, you want to be your risk and return to be as close as possible to this curve, which means that the efficient portfolio is a portfolio which gives you a balanced level of risk and return. Okay, this is a very core understanding. If you don't understand this, you will be attracted to invest into things like all the scam that promise high return but with a relatively no or very low level of risk. So, but what if your investment return actually falls out or far from this curve, meaning that your investment return is really not efficient? Because imagine if you're getting a 3% return from your cash deposit in banks, no risk, okay, cash deposit, no risk, but you're also getting a 3% return on that particular year on the same period of time from your equity, from your stocks, then you know that your stocks is not really efficient because it's giving you only a 3% for that year, but stock have a higher risk than fixed deposit or cash deposit. Okay, and that is what in layman terms how to explain modern portfolio theory by Harry Markowitz. Again, before we wrap, is that in other words, there's no additional expected return can be gained without increasing the risk of the portfolio. You want a higher return, you have to contend with higher risk, higher volatility, meaning that as equal likely that your portfolio can gain 50% in 1 year, it's equally likely your portfolio will be dropping 50% in any of the 4 years, like what I've shown you over here. So if I put here 0.000% for the rest of the 4 years, actually it's already very good. I'm already expecting, I'm already projecting a best case scenario for you, because something that can go up 50% in 1 year, it's equally likely to go down 50% the other year. So that means that you are actually getting nowhere in your investment return. Now, if you like videos like this, you want me to be hitting you with more informative videos like this, please click on subscribe and to this informative videos, and I'll be hitting you more and more with those videos like this every week. Okay, take care.